That's, I think, one of the most important things. Understanding that the sponsor has credibility, has done deals, has got a great team, and aligns with what you're trying to accomplish. If you can find that, man, that is... Hello and welcome. My name is Gino Barbaro, co-founder of Jake and Gino, and on this how-to episode, we are going to be discussing a very important topic: how to evaluate sponsors in a multifamily syndication. Now, right now, syndicators and multifamily in general, they're having a difficult time in the last few quarters of actually going out and paying those preferred rates of return. And a lot of this could have been avoided by someone out there as a limited partner or somebody investing in these deals. When the money's easy and the money's flowing, people get really careless. Now, I'm going to make an analogy. When you're going out and you're going to the doctor's office and you're vetting a doctor, do you just take it on whim and you say, hey, yeah, I think this doctor's going to be okay? Or you have a problem with your car and you got to bring it to the mechanic. Do you just choose any car mechanic, or do you vet that mechanic out? Do you get referrals? Do you see the work that they've done? Do you go look at the reviews, or just say, here's the keys, I trust you? Well, that's what it seems like it's been happening the last couple of years with these syndications. There's a lot of people who've started the business. They have no track record. They have no success, but they can really pitch a great deal. And that's what's been going on. So in this how-to right now, we're going to be discussing how do you vet that sponsor? What are things that you need to look for? Remember, are you looking for a great sponsor? Or are you looking for a great deal? It's a very difficult question. I would always say bet on the jockey, not on the horse, right? You're betting on the team versus just betting on the product that's being sold. That's so important. And in layman's terms in multifamily, if you've got a great sponsor, but a marginal deal, that works so much better than having a great deal and a marginal or a bad sponsor. Because those great deals, they can be around. But then when the market cycle shifts and things change, that deal is not so great. But if that sponsor is not coming up to bat and not doing what he or she is supposed to, that deal is going to fall apart. Those great sponsors are the ones out there that are working really hard, that are communicating, that are out there telling you what's going on during the good times and the bad. So first thing you need to look for. Let's jump right in. First thing, what's the sponsor's track record? As in the mechanic, how many cars have they fixed? How many operations have they done? How long has that person been in business? It's really important how, as I'm getting older, I can say this, right? As you get older, you get a lot wiser. I'm not any better in this part of the market cycle investing than I was back in '08. Other than the fact that I went through '08, I saw what happened. I learned my mistakes. Most people back then looked at it and said, that's it, I'm done investing. Then they got caught up back in the 2015, 16, 17, and all this euphoria now. I saw what happened in 2008. I learned from my wisdom, from those mistakes that I made, and I carried it over into this part of the market cycle. I know history is going to repeat itself. And being around a long time and having experience gave me a lot of, as far as experience, and it gave me a leg up on a lot of the competition, not making those mistakes. One of the mistakes that people have been making the last couple of years, forcing deals. My one big tenet, the thing that I love to say the most, is no deal is better than a bad deal. Now, how do I know that? Because I've been through bad deals. I don't want to force any bad deals anymore. And there are a lot of people out there in the last couple of years forcing bad deals. Remember, it's buy right, manage right, and finance right. Well, if your finance leg was shaky 2 years ago, guess what? It's completely crumbled right now. You're having problems. So the sponsor's track record is really important. Now, how do you look at a sponsor's track record? There's a few things you need to look for. Online reviews, probably one of the most important things. You can go on there, Google that person. What are people saying about them? When you go to events, meet the sponsors. There's a lot of investors. We're having Multifamily Mastery 6 now in October. In the next week or two, there's going to be a lot of multifamily syndicator sponsors out there. Have the conversations. Talk to them face to face. If you're willing to invest money in that deal, you want to meet that person face to face, possibly go fly to the property. How do I know that? Back in 2006, the Maserati Mike story. I invested with a guy named Maserati Mike who had a nice gold Maserati. I made that mistake. I didn't go down to the property and do a property tour or walk with him at that property. I didn't feel it out. I just trusted him. I didn't vet him like I'm telling you right now. Interview that sponsor. Get on the call, interview them. Let's see what their current deals are. How have you done? How's your track record? Right? Maybe possibly ask that sponsor, hey, can I talk to a couple of your investors? And if the sponsor says, no, not really, to me, that's sort of a red flag. I like to see what their investors are doing and how they've enjoyed the process. Now, a lot of sponsors may not allow you to do that, but at the very least, talk to the sponsor about their current deals, what deals they've done, what deals they're doing. You want to see if they've done any deals that went full cycle. What that means is they bought the deal, then they at least exit it by a refinance, giving the proceeds back to the investors, or they've sold a deal. How has that gone? What did you project on the deal? And what did you actually return on the deal? It's really important. That's so important. So you're always going out to see what the sponsor's track record is. And if you want any more of this information, just go to jakeandgino.com/webinar. Every month, Jake and I put on live webinars. You can ask us these questions that we're talking about as far as sponsoring, as far as syndication, jakeandgino.com/webinar. Now, the second question, now that you've felt pretty good with the sponsor, you like the sponsor. You like their track record. You like what they're doing. You like their business plan. What is the sponsor's fees? Let them tell you what their fees are. Are there acquisition fees? And by the way, are you getting acquisition fees paid before any of that money gets distributed to the investors? It's important to know. I'm not saying it's a good or bad thing, but if they're getting fees up front and they're projecting cash flow for zero for the next year to 18 months, is that a deal you want to be in? They're getting paid, but you're not going to be getting paid for the next 12 to 18 months. You have to just know that up front. Are there disposition fees, meaning that when they sell the asset, do they get a percentage? What are the asset management fees, if there are any? Are they managing the property? Are they getting property management fees? That's a very important question. All of the fees, try to understand what they are. Is there construction management fees? Are they managing the deal and they're getting paid management fees to manage the construction? Now, these are all typical fees, but you just want to know upfront what you're going to be paying. The next one, are there case studies available? This would be great. I mean, sponsors who really have done deals, they'll show you case studies. And if they've never done a deal before, they better have a case study to be able to show you to see what they're trying to execute. Once again, when I invest with a sponsor who's never done a deal before, the only time I would do that is if that sponsor is working with another sponsor who has a ton of credibility and a ton of credit. There's been a lot of sponsors over the last 2 to 3 years who've not been able to GP, general partner, their own deals. They would co-general partner with someone else who has a ton of credibility and has a ton of experience. So look for that. That's going around a lot in the market right now. This next one is so important. Ask for a list of their team members. Who does a syndication company or who does a sponsor have as a list of their team members? Who is on their property management company? Are they managing or are they using third-party property management? Who is their syndication attorney? Do they have an acquisitions team? Who are the lenders that they're using? All important. Do they have a CPA? Do they have cost segregation? All you're trying to do is you're trying to check and see if they have all their ducks lined up. They have everything ready to go. Who's creating their entity documents? They should have all these team members laid out for you. Now, this next one is so important because it's really about you as well. What is their investing strategy? If they can't tell you this clearly, that's a red flag. For us, our investing strategy is buy right, manage right, and finance right. And our strategy is to buy right and sit tight. We like these assets to buy them, to hold them for the longer term. We like to refinance the proceeds out. We like to continue to hold the asset. If you don't like that model, then you as the investor probably should not invest with me who's sponsoring, syndicating this deal. Understand what their business plan is or what their framework is for that specific deal. It's important. And if they executed it, if they've never done a 150 unit value add deal where they have to turn 80 of the units at a high level turn and it has to get done in 18 months, that may be challenging. That may be risky. But if they've done a couple and they're like, oh, okay, they've done a couple of these, then this is pretty safe for me, then I'll do that. Understanding what their investing strategy is really important for you and understanding what your goals are. If you're the type of investor that likes his money back or her money back within the next 24 months, but the sponsor is saying, hey, we're looking at the long term, 5 to 7, maybe even 10 years, that's probably not a good fit for you and for the sponsor. Don't blame the sponsor on that once you invest. Just understand what their business plan is or what their framework is. If it doesn't align with your goals, you're out of there. Don't even decide to invest in that deal. This next question has been going on for the last few years, and this is important. Ask the sponsor or the syndicator flat out, are you over-raising? Do you have enough money put aside for CapEx, for all those repairs? On our very first syndication, we were a little light with the capital raise. Thankfully, we didn't go through the burn because we didn't turn all the units, so we had enough raised. But when you're over-raising money, that syndicator or that sponsor has to pay a preferred rate of return on that capital overraise. Now, it's good when you're first or second, you're overraising a little bit more to have that cushion. But there's been a lot of syndication companies out there and sponsors who they've overraised and then they've given that back to the investor, and they're calling it cash flow. It's not a distribution or cash flow. You're just returning capital back that you overraised. But that's how they're playing the shell game. And that's how you know syndication has been going hot for the last couple of years, because a lot of these companies have done it. They've been able to buy. There's no cash flow involved in these deals. All they've been doing is being an appreciation play and flipping. You have to be aware of that. Why are you overraising? Where is this money going to as far as this overraise? And are you going to draw that back and show that as cash flow? That'll make you seem very intelligent as an investor. And you'll see right away if that syndicator, that sponsor is going to do that. And you'll, like I said, you need to get in front of them, ask them these questions. That body language means a lot. If they hesitate on that question, then they're doing that. And if you're okay with that, that's fine. I just want you to go into this deal eyes open. And this very last one, I touched on it a few seconds ago, but does it fit your needs and your investing goals? Because you're the most important person in this category, what we're discussing. You as the limited partner are going into this deal. Now, I think the problem with limited partners, what's been going on for the last couple of years, is they just try to find somebody and they hand off their money and they think they're going to be passive. There is a lot of passiveness in this when you're a limited partner. But the majority of the work has to happen up front. That's why at Jake and Gino, a lot of people get into multifamily. They start investing in multifamily syndications by being a passive investor. It's an amazing way to start learning how to invest. But you still need to learn the framework. What are you buying? What price points? What's your buying criteria? What markets you investing in? Great. You need to understand the buy right. Then you need to understand the financing portion of this deal. And then understanding, obviously, the third pillar, which is really important, the manage right or the asset management. But if you don't get those three pillars right on the front end, and this investor or this syndicator is investing in a deal that's not in your target market, he's investing in a deal that's a long-term hold and you want something shorter, understanding what your criteria, what your framework is, and then finding those sponsors who align really well with you. That's, I think, one of the most important things. Understanding that the sponsor has credibility, has done deals, has got a great team, and aligns with what you're trying to accomplish. If you can find that, man, that is power there. Then you jump on board and you say, yes, I want to invest passively in your deal, and you start the journey there. And then a lot of our students start that way, and then all of a sudden they start from being a limited partner. Then they get into the general partner realm where they start becoming co-GPs, or they start becoming the lead sponsor in the deal. And then from there, they start doing deals on their own, JVs. There's no right way to do it. But I think for myself, if you're a high income earner and you have money sitting in a 401k, put it into a self-directed IRA. Start investing in these syndications because there's so much money to be made in multifamily. And it's an amazing way to diversify your portfolio. You may have a large stock portfolio. Don't know why you'd have that. Just joking. But if you do, take some of that money out, start learning how to invest in real estate, and start learning how to invest with these sponsors. Now, if you want more information, or better yet, if you want a copy of our book, Barbaro Profits, just email me, gino@jakeandgino.com. It teaches you the framework on how to buy right, manage right, and finance right. And in there, as you're reading this, you'll start formulating your own personal business plan on how to start building multifamily. And from there, once you understand that and you use this video that we just recorded right now on how to choose a sponsor, you're going to have your plan. You're going to try to match it with the sponsor's plan. And that match becomes a match made in heaven. Thanks again for listening to this how-to. It's all about taking empowerment, understanding the model, understanding what you're trying to accomplish and what the sponsor is, and aligning those goals. And we will see you on next week's how-to. Thanks, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.